Friends, thank you for being here today. I want you to stop for a moment and think about a question that sounds simple, but the more you sit with it, the more unsettling it becomes. Where is your money right now? Not in theory, not on a screen, but physically, structurally. Where does it actually live? Because what happened on February 17th, 2026 in Canada is not a story about one company. It is not a story about a software glitch or a regulatory footnote. It is a story about a fault line that has been spreading quietly beneath the entire architecture of the modern financial system. And this part has already begun. On that day, the Bank of Canada issued an immediate order to XTM Inc. to cease all retail payment activities, not wind down, not restructure, cease immediately. The bank cited in its own language serious concerns about the safeguarding of client funds. People woke up that morning fully expecting to access their money through a platform they had trusted, and the door was locked, not by fraud, not by bankruptcy, by a central bank that decided the risk was too great to leave the door open for even one more day. Now, here is the part nobody expects. This is not the crisis. This is the warning shot. What I call the big secret of the entire system is hiding in plain sight within this single enforcement action. The Bank of Canada is not panicking over one fintech firm. They are panicking over what one fintech firm represents. Because behind XTM is an entire ecosystem of digital wallets, prepaid card platforms, and payment applications holding billions of dollars of ordinary people's savings. Funds that are not insured, not protected, and not held inside any institution the central bank actually controls. And if that ecosystem starts to crack, the question is not whether your digital wallet is safe. The question is who gets to decide when your digital wallet stops working. We don't have months on this. This is happening in days. Let me give you the scale of what we are actually discussing because the numbers are staggering. Retail payment service providers in Canada collectively manage tens of billions of dollars in end user balances. These are not bank deposits. They are not covered by the Canadian Deposit Insurance Corporation. They are, in the language of the regulators themselves, funds that must be safeguarded, held separately in trust, away from the operating capital of the company managing them. That is the rule, but the rule depends entirely on the company following it. And the Bank of Canada just told you in writing that XTM was not following it. That is not a theoretical risk. That is observable. That is math. Here is where I want to take you back, not to last month, not to last year, but to the foundational architecture of how this system was built, because you cannot understand the crack without understanding the wall. In 1694, the Bank of England was founded. That single event established the template that every Western financial system has followed ever since. The core idea was elegant. A central institution would manage the currency, backstop the banks, and serve as the lender of last resort. For over 300 years, that model worked because the institutions at the center of the system, the banks, were the only ones who could hold your money. You deposited into a regulated bank. The bank lent that money out. The central bank monitored the bank. The chain of custody was clear. The chain of accountability was clear. And critically, the chain of protection was clear. But here's the part they never put in the official reports. Somewhere in the late 1990s and accelerating through the 2000s, a new class of financial entity began to emerge. Entities that held money, moved money, and profited from money, but were not banks. They did not take deposits in the legal sense. They did not lend at scale. They called themselves payment platforms, Fintech companies, digital wallet providers, and because they did not technically fit the definition of a bank, they slipped through the gaps in the regulatory architecture that had been built over 3 centuries to protect you. Think of it this way: your bank account is like a house built to code, inspected, insured, and backed by the full weight of the state. A fintech wallet is like a structure that was built in the years before the building codes caught up. It looks like a house. It functions like a house. People live in it, financially speaking. But when the storm comes, the question of whether the walls will hold is a completely different question. And this is where the first domino falls. The Retail Payment Activities Act, the RPAA, was Canada's attempt to finally close that gap. It gave the Bank of Canada authority to oversee non-bank payment firms. It required them to register. It required them to safeguard client funds in segregated accounts. It created, for the first time, a real regulatory chain of custody for the money sitting inside your digital wallet. That sounds reassuring. And it is, in the same way that installing a smoke alarm is reassuring. The alarm is necessary, but the alarm does not mean the house will not burn. What I call the mechanism hiding in plain sight is the following. The RPAA gave the Bank of Canada the authority to act. The XTM order proves the Bank of Canada is now willing to act. And that combination, authority plus willingness, means one thing. The Bank of Canada has reviewed the sector and found something that concerned them enough to pull the trigger. That is not a routine compliance check. Routine compliance checks do not result in immediate cease orders. Routine compliance checks result in letters. They result in improvement plans. They result in timelines. What the Bank of Canada issued was not a letter. It was a shutdown. But that's not the real problem. The real problem is what XTM represents in terms of the broader architecture. This is the detail even analysts tend to miss. XTM is a publicly listed company. It operates in the open. It files reports. It has auditors. It has governance structures. If a publicly listed, audited, regulatory registered firm can receive an immediate cease order over safeguarding concerns, what does that tell you about the firms that are not publicly listed? What does that tell you about the platforms operating in the gray zones of digital finance, the ones that are smaller, less visible, and carrying the balances of hundreds of thousands of ordinary Canadians who have never once thought to ask whether their money is actually safe? This is not a conspiracy, it is a stated policy. The Bank of Canada's own mandate is financial stability and payment system integrity, and when a central bank starts enforcing that mandate aggressively, it is because they have looked at the data and concluded that stability is at risk. The data forces one conclusion: the XTM order is not the beginning of a crackdown. It is the visible tip of a review that has been underway for months, examining the entire non-bank payment sector for exactly this kind of structural vulnerability. And here is where we reach the system's most crucial secret, which we will explore in the next section. Because once you understand what happens when a payment firm freezes, not just to the firm's customers, but to the entire payment ecosystem sitting on top of the same banking rails, the picture changes entirely. The question stops being, is XTM safe? And starts being, what does the Bank of Canada know about the sector that it has not yet said publicly? We haven't even reached the breaking point yet. Let me show you what actually happened. Not the version in the press release, not the version in the financial headlines, but the structural version that tells you why this moment matters far beyond the borders of Canada. XTM Inc. operated what is known in the industry as a prepaid card and digital wallet platform. Their flagship product was something called the Any Day Pay System, a tool marketed primarily to employers who wanted to pay workers instantly, on demand, between payroll cycles. Warehouse workers, gig economy drivers, retail staff, people living paycheck to paycheck who could not afford to wait 2 weeks for their wages. These are not wealthy investors. These are not sophisticated market participants. These are ordinary people who trusted a digital platform with their earned income because the platform told them it was safe, it was instant, and it was theirs. And this is the moment small businesses and their workers get crushed. Here is what the Bank of Canada found, or more precisely, here is what the Bank of Canada found serious enough to pull an immediate cease order rather than issue a correction notice. The safeguarding rules under the RPAA are not ambiguous. They do not allow interpretation. A retail payment service provider must hold end user funds separately from its own operating capital, not mostly separately, not largely separately, completely separately, in designated trust accounts with full auditable records of every single dollar. The moment those funds are commingled, the moment the wall between customer money and company money develops even a hairline fracture, the entire edifice of trust that the platform is built on begins to crumble. This is not theoretical. This is observable. And here is where the canary enters the coal mine, because XTM is not a name that will make headlines in the financial press for long. It is too small. The numbers are too contained. The story on its surface looks manageable, but the canary's job is not to survive the gas. The canary's job is to die first, so that the miners behind it know what is coming. And what is coming is a systematic review of every registered and unregistered retail payment service provider in Canada by a central bank that has now demonstrated it will act without warning. This is vanishing in real time. Let me be precise about what that means for the sector. Under the RPAA framework, the Bank of Canada has the authority not just to audit, but to order corrective action, not just to observe, but to shut down. And the firms that should be most afraid of that authority are not the ones that are obviously failing. The ones that should be most afraid are the ones that have been operating in a gray zone, technically registered, technically compliant on paper, but carrying structural vulnerabilities in their fund management that have never been tested under real regulatory scrutiny, because those firms have now seen what real regulatory scrutiny looks like. And they know that the Bank of Canada is not issuing warnings anymore. They are issuing orders. But once this shifts, everything above it starts to shake. Here's the part the experts gloss over. The digital payment ecosystem is not a collection of isolated islands. It is a network. Every fintech wallet, every prepaid card platform, every digital payment provider sits on top of a shared infrastructure, the banking rails of the established financial system. When you send money through a fintech app, that money ultimately clears through a regulated bank. The fintech is the interface. The bank is the plumbing. And that means the health of the fintech sector is not separate from the health of the banking sector. It is layered on top of it, like scaffolding on a building. The scaffolding can fail without bringing down the building. But when the scaffolding starts to fall, it creates risks for everything beneath it that nobody accounted for when the scaffolding was first erected. Here is what that looks like on the ground. Imagine you are a small business owner in Ontario. You have been using an any-day style platform to manage your payroll, specifically because it allows you to pay workers on demand, which helps you attract staff in a competitive labor market. That platform has just received a cease order. Your payroll infrastructure is, as of today, frozen. You cannot use it. You cannot access the funds that were sitting inside it pending distribution. You cannot pay your workers on Friday, not because your business failed, not because your workers did not earn their wages, but because the platform you trusted to hold those funds was not holding them the way the central bank required. That is the human cost of a structural fault line. And it is not hypothetical, it is happening now, but that's not even the part that scares me. What scares me is the second order effect, because when employers cannot pay workers, workers cannot pay rent. When workers cannot pay rent, landlords cannot cover their mortgages. When landlords cannot cover their mortgages, the banks carrying those mortgages start to see delinquency rates creep upward. And all of this, every single domino in that chain was set in motion not by an economic recession, not by a market crash, not by a global financial crisis, but by the failure of a safeguarding rule inside a single mid-sized fintech company. This is the crack that becomes an earthquake. And now I want to ask you the question you should already be asking yourself. If XTM is the canary, the visible, audited, publicly listed canary, what is happening inside the platforms that are not publicly listed? What is happening inside the dozens of smaller payment apps, the niche digital wallets, the employer payment platforms that serve specific industries and communities that have registered under the RPAA but have never had their safeguarding practices examined by anyone with the authority to shut them down? The answer is something the Bank of Canada has not said publicly, but their actions tell you everything, because a regulator that is confident in the health of its sector does not issue immediate cease orders. A regulator that has looked at the sector and likes what it sees does not move without warning. The data forces one conclusion. The Bank of Canada has looked at the non-bank payment sector, and it does not like what it sees. This is not a prediction. This is math. Here's the part nobody expects. And this is where I need you to pay very close attention. Let me dismantle 3 safety assumptions that the average Canadian is carrying right now, because each one of them is a fault line. The first assumption is that your money in a digital wallet is the same as your money in a bank. It is not. Your money in a bank, a regulated deposit-taking bank, is covered up to $100,000 by the Canadian Deposit Insurance Corporation. That is a legal guarantee backed by the federal government that even if your bank fails entirely, your money comes back to you. Your money in a fintech wallet carries no such guarantee. If the platform fails, you are an unsecured creditor. You join the queue. You wait for the liquidator to assess what is left. And in many cases, what is left is significantly less than what you put in, because the safeguarding rules that were supposed to protect it were not followed. The second assumption is that regulation means protection. It does not. Regulation means oversight. And oversight means the regulator can see the problem. It does not mean the regulator can prevent the problem, or that by the time the regulator acts, there is still enough money in the segregated accounts to make the customers whole. The XTM cease order came because the Bank of Canada identified safeguarding concerns. But identification is not resolution. The order stops further harm. It does not undo the harm that may already have occurred. The liquidity tide is going out, and we are about to find out who has been swimming naked. The third assumption is the most dangerous one. It is the assumption that because the problem is in a fintech company, it is contained, that it is a technology problem, a startup problem, a sector-specific problem that will be solved by better apps and better compliance officers. This is where common sense actually becomes your enemy, because the deeper reality, the structural reality, is that the rise of the non-bank payment sector was never just a technology story. It was a credit story. It was a story about the financial system finding new ways to move money outside the regulatory perimeter that central banks had spent 3 centuries building. And now that the central bank is reasserting that perimeter, the question is not whether the fintech sector can adapt. The question is what gets exposed in the process. And here is where the cascade becomes unstoppable. Because the Bank of Canada is not acting alone. Regulators in the United Kingdom, in the European Union, in the United States have all been moving at different speeds with different authorities toward the same conclusion. The non-bank financial sector is carrying risks that the traditional regulatory framework was not designed to contain. Canada, in issuing the XTM order, has just moved further and faster than most, but it is moving in the same direction as every other major financial regulator on the planet. And when regulators all over the world start moving in the same direction at the same time, that is not a coincidence, that is a signal. But this isn't even the part that changes everything. What changes everything is the question of consolidation, because every firm that gets shut down, every platform that fails a safeguarding review, every digital wallet that gets frozen does not just remove a competitor from the market, it pushes the customers of that platform, along with their money, their payroll relationships, and their financial habits, back toward the regulated banking system, back toward the institutions that the central bank controls, back toward the architecture that was built in 1694 and has been evolving ever since to ensure that every dollar in the economy flows through channels that the state can see, regulate, and when necessary, close. This is not a conspiracy. It is a stated policy. The Bank of Canada does not hide its mandate. Financial stability, payment system integrity, and consolidation of control over every dollar in the system is entirely consistent with both. The XTM order, viewed through this lens, is not just an enforcement action. It is a redrawing of the boundary between the official financial system and the shadow financial system. And the boundary is moving in one direction only. We haven't reached the breaking point yet, but we are closer than most people realize. And what comes next is worse. Let's cut through the noise. Because everything we have covered so far, the XTM cease order, the RPAA framework, the safeguarding failures, the second order effects on workers and landlords and mortgage books, all of it is converging into a single moment. And if you only take one thing from this conversation, I want it to be this. We are not watching a story about one fintech company failing a compliance test. We are watching a convergence. 3 distinct forces arriving at the same point, at the same time, from 3 completely different directions. And it is the convergence, not any single element of it, that transforms this from a financial news story into a structural event. The first force is the structural break in Canada's non-bank payment sector. The RPAA framework has created for the first time a regulatory architecture with real teeth. The Bank of Canada has demonstrated with the XTM order that it is prepared to use those teeth immediately and without prior warning. What that means in practice is that every retail payment service provider in Canada is now operating under a scrutiny regime that did not exist with the same enforcement intensity 12 months ago. The firms that are compliant will survive. The firms that are not compliant will face orders, and the customers of those non-compliant firms, the workers, the small business owners, the gig economy participants who rely on these platforms for their daily financial lives, will be left holding accounts they cannot access while regulators and liquidators sort out what remains. This is vanishing in real time. The second force is the broader liquidity pressure inside the Canadian financial system. This is the part even analysts tend to miss. Canada's household debt-to-income ratio is among the highest in the developed world. Canadian consumers are carrying mortgage loads that were structured during a period of historically low interest rates. Those rates are no longer low. Every month that passes at current rate levels is another month of pressure on household balance sheets, pressure that reduces discretionary spending, pressure that increases the probability of mortgage delinquency, pressure that tightens the credit conditions for the small businesses that rely on consumer spending. And into that environment, an environment of compressed household liquidity, comes the XTM order and the sector-wide review it implies, freezing additional pools of working capital that ordinary Canadians were depending on to function. For pensions, for payrolls, for household budgets, this is catastrophic. And the third force, this is the one that ties the entire edifice together, is the question of sovereign control over the payment system itself. Because the Bank of Canada's move against XTM is not just a regulatory enforcement action, it is a territorial claim. It is the central bank saying in the clearest possible language that the payment system is sovereign infrastructure. That money moving through Canadian hands in Canadian dollars to pay Canadian workers, that money belongs inside the regulatory perimeter, not outside it, not in gray zones, not in the shadow architecture that grew up around the edges of the official system over the past 2 decades, inside, under observation, under control. And here is where the cascade becomes unstoppable. Because once you understand that the Bank of Canada is making a territorial claim, not just enforcing a rule, the question changes. It is no longer, will other fintech firms be reviewed? Of course they will be reviewed. The question becomes, what does Canada's financial system look like on the other side of this consolidation? What does it look like when the central bank has successfully pulled every significant pool of retail payment activity back inside the regulated perimeter? I will tell you what it looks like. It looks like a system with far fewer payment options, far greater central bank visibility into every transaction, and far less space for financial activity that sits outside the state's line of sight. That is not a conspiracy. It is a stated outcome. It is, in fact, the explicit goal of the RPAA framework, and it is happening right now. But I need to stop talking about the mechanics for a moment, because the mechanics are not the real danger here. The real danger is in your mind, and this is the pivot that matters most. Human beings are hardwired to believe that tomorrow will look like yesterday. Psychologists call it normalcy bias. It is the cognitive mechanism that allows us to function, to go to sleep at night without catastrophizing about every risk in the environment. And in normal conditions, normalcy bias is useful. It keeps us calm. It keeps us productive. It keeps us from making rash decisions based on incomplete information. But normalcy bias becomes lethal, not physically, but financially lethal, in precisely the moments when yesterday is no longer a reliable guide to tomorrow. And this is one of those moments. Here's what that looks like on the ground for the average Canadian household right now. You have money in a Fintech wallet. You have been using it for months, maybe years. It has worked every single time. The interface is clean. The transfers are fast. There has never been a problem. And so your brain has filed it alongside your bank account in the category of reliable financial infrastructure. But the Bank of Canada just demonstrated that this category was always a fiction. The reliability you experienced was not because the system was structurally sound. It was because the system had not yet been stress tested. It was because the regulator had not yet shown up with the authority and the willingness to pull the plug. Now, both of those things have changed. The stress test has begun. The regulator is in the building, and your normalcy bias is whispering that it will all be fine because it has always been fine before. This is where common sense becomes your enemy. There is a second psychological trap that I want to name directly because it is subtler and more dangerous than normalcy bias. It is what economists call the money illusion. The money illusion is the tendency to think about wealth in nominal terms, in the number of dollars you have, rather than in real terms, in what those dollars can actually buy. And in a financial environment where platforms are freezing, where regulatory reviews are multiplying, where the cost of financial access is rising as compliant options consolidate and non-compliant options are removed. In that environment, the number of dollars in your account can stay exactly the same while your actual financial freedom quietly evaporates. You see the balance on the screen. The balance looks fine, but your ability to access that balance, to move it, to deploy it freely, that is diminishing in real time. You become richer on paper while becoming poorer in practice. And by the time the number on the screen finally changes, it is too late to do anything about it. This part isn't a prediction, it's math. So let me ask you a direct question, not a rhetorical question, a real one. Do you own assets or do you own claims on assets? This is the binary choice that the current moment is forcing, and it is the choice that most people are not consciously making, which means it is being made for them by default. A claim on an asset is a promise. It is a contractual right encoded in a platform, enforced by a regulator, backed by a corporate structure that says you can access value when you want it. A bank deposit is a claim. A Fintech wallet balance is a claim. A stock market ETF is a claim. These are all promises made by institutions. And the XTM story is, at its core, a story about what happens when an institution stops keeping its promise. The claim was there. The documentation was there. The regulatory registration was there. And yet the money was not safeguarded the way it was supposed to be. The promise was not kept. And when the promise is not kept, the claim is worth less, sometimes significantly less, than the number on the screen suggested. An asset, by contrast, is something you hold, something that exists independently of an institution's promise to deliver it. Gold, land, physical property. These are not promises. They are not claims. They are things. And in a financial environment where the gap between what institutions promise and what they can actually deliver is being exposed, not by fraud, not by conspiracy, but by the ordinary mechanics of a regulatory system reasserting its perimeter. The value of holding actual things rather than claims on things becomes something that is very difficult to overstate. Here's the part the financial industry does not want you to internalize. The reason the modern financial system has been so effective at moving people away from physical assets and toward paper claims is precisely because paper claims are easier to manage, easier to monitor, easier to tax, and easier to freeze. A gold bar in your possession cannot be frozen by a central bank order. Land registered in your name cannot have a cease order placed on it by a payment regulator. These assets exist outside the system's perimeter. And in a moment when the system is actively redrawing its perimeter, pulling everything it can back inside, asserting control over every dollar flowing through every channel, the things that exist outside that perimeter are not relics of a pre-digital age. They are the only category of wealth that cannot be made inaccessible by an institutional failure or a regulatory order. I am not telling you to panic. I am telling you to prepare. Those are completely different things. And here is the most important nuance in this entire conversation. Stepping out of the paper system does not mean abandoning financial participation. It does not mean living off the grid. It means understanding that in the current environment, the ratio between your claims and your actual holdings deserves serious examination. Because when the perimeter shifts, and it is shifting now visibly, measurably, with documented enforcement actions, the people who are holding claims find out very quickly what those claims are actually worth. And the people who are holding assets find out that the storm, while disruptive, has not touched the foundation they built. Let me bring this full circle. What we have witnessed in the XTM enforcement action is not the end of Fintech. It is not the end of digital payments. It is not even the end of the specific platforms affected. What it is, structurally, historically, consequentially, is a realignment, a moment in which the financial system acknowledges, through action rather than words, that the architecture of the last 2 decades has developed structural vulnerabilities that can no longer be left unaddressed, that the edifice of shadow payment infrastructure, built rapidly and regulated loosely, has developed fault lines significant enough that a central bank has decided the risk of inaction outweighs the disruption of enforcement, that the scaffolding needs to come down and the building beneath it needs to be reinforced before the scaffolding's weight causes something far worse. This was inevitable the moment the RPAA was enacted and the Bank of Canada was given enforcement authority over retail payment providers. The only question was when, and the answer, as of February 17th, 2026, is now. We are facing a convergence, a structural break in Canada's non-bank payment sector, a domestic liquidity squeeze on already stretched household balance sheets, and a sovereign consolidation of control over the payment system itself. These 3 forces are not moving toward the same point. They have already arrived. For the average household, this means the window for re-examining your financial architecture is not months away. It is not something to think about. It is open right now, and it will not stay open indefinitely. The platforms that exist today in gray zones will either comply and survive in a diminished form or face orders and cease. The customers caught in that process will have claims that are temporarily and in some cases permanently inaccessible, and the migration back toward regulated institutions, while orderly in intention, will be disorderly in practice. History favors the prepared, and the window for preparation is closing. I want to leave you with this. The XTM story will fade from the headlines in days. The press will move on. A new story will replace it, and normalcy bias will do its work, quietly reassuring the majority that because the crisis did not arrive in the form they expected, on the timeline they feared, it is not arriving at all. But the fault line does not disappear when the headlines do. The structural vulnerabilities exposed by this enforcement action, the uninsured balances, the commingled funds, the claims that rest on promises rather than assets, those remain exactly where they were. And the central bank that has just demonstrated its willingness to act without warning remains exactly as willing as it was on February 17th. This is not a conspiracy, it is a stated policy, and the prepared already know what to do next.